Dear members and participants, Assalamu alaikum. It's a great pleasure to welcome you all to today's session, and I sincerely thank you for taking the time to join us. As chairman of the UK Ireland chapter of ICAP members, I'm proud of the continuous efforts of our chapter in bringing together a series of high quality and relevant professional development initiatives. Over recent months, we successfully delivered a technical webinar on FRS 102 Section 20 leases, which was highly appreciated by our members. In addition, we also hosted the first episode of our PRA webinar series, Introduction to PRA Capital Requirements and Reporting, which laid a strong foundation for the discussions we continue today. Alongside technical excellence, we also recognize the growing importance of soft skills in today's professional environment, which led us to organize the session on mastering communication, conscious listening, and powerful speaking. The positive response to both streams of learning has been truly encouraging. Building on this momentum, we are delighted to present the second episode of our webinar series on PRA regulations and reporting requirements for banks. This series is particularly significant, and I would say one of its kind, as it addresses a highly specialized and evolving area that is critical for professionals working within the financial services and regulatory landscape. Today's session on credit, raise capital requirements and reporting, final Basel 3.1 rules is both timely and highly relevant. We are truly privileged to have with us Mr. Waqar Aslam as our session trainer. Mr. Waqar is a seasoned professional with over 2 decades of experience across London's financial services sector. He has led finance and prudential regulation audit functions, bringing deep expertise in regulatory reporting, internal audit, and building high-performing teams. His practical insights and extensive industry exposure make him exceptionally well-placed to guide us through today's complex and evolving topic. I'm confident that participants will greatly benefit from his knowledge and real-world perspectives. With that, I would now like to hand over the session to Mr. Waqar Aslam. Mr. Waqar, thank you once again for joining us today. The floor is yours, and we look forward to an insightful and engaging session. Thank you.
Assalamu alaikum. Good afternoon, everyone. Kaleem, thank you much for your time, and I really appreciate the ICAP for organizing these webinars. And thank you much for this opportunity. Uh, Everyone, thanks for joining us today. This webinar is on Basel 3.1 regulations. Uh, we're focusing on the major change since Basel 3 came into force. These regulations are implemented by PRA through PS 1 by 26, which was released on 20th of January, and these are effective from 1st of January 2027. These regulations are changing the way the capital is computed, the capital is managed in a material way, and they impact all the risk types based on for the capital computation, including the credit, market risk, operational risk. Uh, the PS 126 is about consistency, comparability, and credibility. The PRA is tightening model freedom, introducing binding input floors, and redefining the way IRB is used for the capital calculation. And the market risk is changing from materially from a simplified standardized approach to an advanced standardized approach as well. Basel 3.1 is not just a compliance exercise. It redefines the way the people manage their portfolios, the data quality, the governance, and ultimately the banks who are able to make changes into their system and implement these regulations in a more effective way will benefit from these changes in the regulations. With this one, we'll move into the document itself. As I mentioned, these regulations are implemented with policy statement 1 by 26. This document, as you can see, is a 492-page document. So what we'll do is we'll go through it line by line, and we have 2 hours to do that. So I think it should be good fun. So jokes aside, let's look at it from a detailed perspective. I'll touch base on the key concepts which are relevant for these regulations. And we will go through with some worked examples and some Q&As as well. Okay. So this PS, the Basel 3.1 regulations, they are applicable for the PRA authorized banks, building societies, and designated investment funds. Uh, Today we will cover the credit risk requirements, and there are two key type of requirements on the credit risk, which is the standardized approach and the internal rating based approach. The key changes within these requirements are the risk weights have been revised, the credit risk mitigation rules have been updated, and the IRB requirements have been changed in a way that less classifications are eligible to use the IRB approach now, as opposed to much wider application earlier. The PRA is expecting banks to implement the adequate systems in order to comply with these regulations. We are left with around a few months now for the first January 27 implementation. So this is a very critical time for the banks for implementing these regulations. Okay. From capital resources and capital requirements perspective, it all depends upon what type of business a bank does. So a bank has assets based on its business type. So different banks will have words in their banking book versus they will have words in their trading book, depending upon the activity which they are taking. And that results into different type of risk exposures they will have. So if you have the banking book exposures, you will have credit risk. But if you are taking trading book positions as well, then you will have market risk under the as well. And similarly, you have the CVA for your derivatives and the security financing transactions. Operation risk is applicable to everyone. And then there's a new concept of output flow, which has been introduced under Basel 3.1. So if you have assets which are leading to your risk-weighted assets, then against these requirements, you should have a capital as well to meet these requirements. And that comes from the equity side of the world. So we have our balance sheet asset, liabilities, and equities. And equities go towards the regulatory capital. However, the definition of the regulatory capital is different and much broader than we see for the IFRS under the IFRS for financial reporting purposes. So the Basel 3.1 PS1 by 26 has brought changes in the capital resources area as well as under the capital requirements. So in order to make sense of things completely, we look at the changes, key changes which have been introduced under the capital resources side, and then we'll come back towards the credit risk capital requirement. One of the key change which went into capital resources is under Article 92. Article 92 defines the Tier 1 capital and the Tier 2 capital resources which a bank is required to maintain. Along with that, it provides a new concept of output flow. We will look into that these definitions or these concepts for a few minutes, and then we'll come back to the credit risk. On a high level, big picture perspective, under PS1 by 26, the Article 92 requires that firm should maintain the following capital resources at all times, which means common equity Tier 1 capital resources of 4.5%, additional Tier 1 resources of 1.5%, and total Tier 2 resources of 2%. All of these add together to 8% capital requirement based on the risk-weighted assets of a firm. So if you have balance sheet assets, you need to compute the 8% RWA requirement against those, and you need to meet that 8% RWA requirement based on different type of instruments which sit under the common equity tier 1, additional tier 1, and tier 2 category. As we go along, I will explain every slide and then we'll take a small break. So you can grasp the concepts and then we move on to the next slide. Okay. Here we will explain what type of instruments are required to be included into different tiers of the capital resources. So under tier 1 capital, we have this is the primary type of capital which a bank maintains. And this capital is there to absorb losses in the going concern. Common equity tier 1 is the main type of capital under tier 1 capital. Tier 1 is split between common equity tier 1 and additional tier 1. And common equity tier 1 includes the instruments which you usually see into your equity in financial reports. These include your common shares, your retained earning, and any share premium on the common equity shares. And this is the highest quality of capital a bank maintains. And as we mentioned, it is required at 4.5% of the risk-weighted assets. We need to maintain an additional Tier 1 capital as well, and that is certain instruments which are like preferred shares or equity-like instruments. They are classified under additional Tier 1 instruments, and you can maintain to 1.5% of additional Tier 1 uh, as well. So the total Tier 1 requirement is 6% of the risk-weighted assets. From reporting perspective, Prudential Regulation Authority requires banks to submit a report called C01 own funds requirement, and that report is submitted on a quarterly basis, and it lists down the capital resources which a firm maintains. So here you can see we have the Tier 1 capital, which includes your common equity Tier 1 capital, and then the instruments like fully paid capital instrument, the share premium regarding related to those, retained earnings, comprehensive income, reserves, and so on. And then the same report covers the additional Tier 1 instruments and the Tier 2 instruments as well. We'll move on to the Tier 2 instruments here. So Tier 2 instruments are the instruments which absorb losses when a bank is gone concern. So the Tier 1 is a going concern instrument, and the Tier 2 are the gone concern instruments. So they are subordinated debts and hybrid security instruments. They are lower in quality to the Tier 1 capital, but still absorb losses in insolvency, supporting the overall resilience for the bank. These instruments have fixed maturity, while your common equity instruments or under the CET1, they don't have any maturity. So that is a clear distinction between these two instruments. So if you have any questions, we'll take those questions at specific time during this presentation, and Kalim will help in that regard. So until now, we have looked at CET1 instrument, Tier 1 additional instruments, and the Tier 2 instruments. However, the 8% risk-weighted asset, uh, it is good to have in the normal circumstances, but under the stress scenarios or when the bank is incurring any losses, there is a requirement to have additional buffers as well. So banks maintain these buffers as a going concern, but these buffers help absorb losses as they occur. For example, bank is required to maintain capital conservation buffer of 2.5% at all times, and this buffer will absorb losses if they take place. Similarly, countercyclical buffer is required between 0 to 2.5% based on the exposures of the bank. And the banks which are globally systematic important institutions and other systematically important institutions, PRA specifically requires them to maintain specific buffers, which is allocated to those specific banks. So all of these buffer requirements are to be met by CET1 instruments as well. So in reality, rather than having 4.5% of risk-weighted assets CET1 instruments, we need to have CET1 instruments something between 7 to 12%. And that takes up the overall total regulatory capital requirement to 10.5% to 15.5%. So, quick recap, under Article 92, we saw that the 8% capital requirement based on risk-weighted asset was required, but there are additional buffers introduced to absorb losses, and these buffers take up the capital requirement to around 10.5 to 15.5% of risk-weighted assets. On this slide, I'm presenting Tier 1 versus Tier 2 comparison. What are the key differences between these two type of instruments? So maturity, Tier 1 instruments are perpetual, they don't have a maturity. Tier 2 instruments have a minimum 5-year maturity. Tier 1 instruments absorb losses while an institution is a going concern, and Tier 2 comes into play when the institution goes into insolvency. Ranking in liquidation is lowest for Tier 1 instruments, and Tier 2 instruments rank above Tier 1 instruments. And examples of Tier 1 instruments is common shares, additional Tier 1 preference shares, and Tier 2 instrument example is the subordinated bonds. Okay, so now we should look at the very critical change which has been made into these rules based on Article 92. This rule limits the use of models, or limits the benefit of models which a bank can take. So under different approaches for credit risk, market risk, bank can use models, and those internal models can come up with a capital requirement which could be materially low as compared to the standardized requirement, which is required to be implemented as a standard. So in order to reduce the benefit of those model requirements, PRA has implemented a total risk exposure amount calculation, and that calculation floors the model requirement against the standard requirement. So if you, in this requirement, the formula here is you need to take the maximum of your unflowed risk exposure amount, multiply it with a factor against the standardized risk exposure amount, and then you make an adjustment based on the own funds requirements, the impact of own funds requirements for based on the advanced approaches. So the benefit of this approach is that if banks compute lower capital, which is very less conservative, then using this output floor, their venture capital requirement can be floored, and it becomes to a more industry standards as compared to different bank having different risk weights for the similar exposures. This output floor is being implemented from 2027 gradually over the number of years, and from 2030 it becomes the fully phased in approach, fully phased in amount. So fully phased in value will be 72.5%. So this factor of X, which we see here, is 72.5% in 2030, and it is introduced gradually 60%, 65 and 70% across these 3 years. So we have the unflowed risk requirement, which would include your IRB approach or your IMA approach as well. And this is a standardized requirement which does not include any of the model inputs. And then we have the own fund adjustment, which effectively eliminates the impact of the IRB or any other modeled approaches on the own fund requirements area. Okay. So as we mentioned here, the approach excludes from STRE our SFT VAR method, IRB approach, securitization IRB, and IMM and IMA approaches. So these are all the model approaches which you could use. So they can sit into this space, but they will not sit into this space. Okay. So in simple words, the PRA has introduced an output floor to limit the benefit of the models which the banks can take. And this brings the capital requirements at a more consistent level across the banks using the standardized risk weights. We have worked example here. In this example, we're looking at the fully phased in output floor, 72.5%. We assume that the bank is using only IRB credit risk as the model approach, and this is under Article 92, as we mentioned before. So we have the formula on the top, and we will compute the output scalar factor based on 72.5% in this one. Uh, these two tables show us the unflowed risk exposure amount and the standardized risk exposure amount against these. The only model approach which we have in this case is the credit risk IRB versus the standardized, which is in this table. All other risk types are treated as a standardized for this example. So we can see 320 is under the IRB, which is materially less as compared to the standardized risk weight of 570 million. And then the total risk exposure amount is 450 million, and the under the standardized it is 700 million. All these numbers are hypothetical and purely for the purpose of this exercise. And just want to emphasize that this is knowledge sharing training session only, and this is and anything from here uh, is purely for knowledge sharing purposes and not for any consulting or advisory purposes. Yeah. Um, so the market risk and all other risk types, you can see these values are taken same across these two tables because they are under the standardized approach. Only the IRB was taken at the model. So we'll use the formula, this formula over here, to look at the unflowed total risk exposure amount versus the standardized risk exposure amount, and we'll compute the own funds adjustment using the hypothetical values, and let's see how it impacts the overall requirement for the bank. So at the moment, we see that the bank would be using the without this flow requirement, the bank would have used 450 million to compute its capital requirement versus the 700 million if another bank would have used the standardized only. And let's see how the floor concept increases this capital requirement if the floor is applicable. Firstly, we compute the own fund adjustment. These are hypothetical values. Uh, Under the IRB approach, you have to make a deduction from CET1 if your provision if your EL value is less than the provision value, uh, or or if it is higher than the provision value, it is added to your tier two instruments. So this formula effectively considers the impact of IRB versus standardized approach use. And the OF adjustment which we have computed here is 25 million on a hypothetical basis. Looking at the unflowed amount of 450 million, we look at the 7 to 5% the final floor value, and then we multiply it with the 500, with the 700 million, which was our standardized risk weights. We add the 25 million OF adjustment here, and we come back to the floor amount of 532.5 million. So we can see that the floored amount is higher than the unfloored amount. So in this case, the bank will have to go with the floored amount. So in order to use the model approach, banks have to get a permission. They have to spend millions in order to get those models running. They have to put model monitoring. They have to put model validation processes in place. And there's a back testing and stress testing as well. And so, so after spending all of this money, the banks will still not be able to use the benefit of those models to the full extent. And PRA is implementing the regulations which are better for the industry, and they bring banks to a similar sort of level playing field. And as a result of it, that limits the amount of benefit which the banks can take from those models. And in this case, we see rather than 450 million, the bank will be using a higher risk weight requirements of 532 million. Based on these requirements, we can see if the CET1 capital of the bank was 40 million, the CET1 ratio would be 40 million divided by 532.5, 7.51%. Similarly, if the tier 1 capital is 48 million, the ratio would become 9.01% based again on this ratio. And then if the fully tier 1 plus tier 2, the total capital is 58 million, then the total capital ratio would be 10.89% based on the output flow. So this is a very material change which has come under Basel 3.1, and this limits the benefit of the advanced approaches. Obviously, it is required to be implemented by the banks, and the implementation is gradual, as we have seen, and up to 2030, it will be implemented on a gradual basis. Okay. Here I present you an analysis based on Bank of England website, which shows the actual capital ratios which different banks have maintained during 2024 up to Q1 25. As we can see, we looked at the total capital ratio requirement of around at a starting point of 8%, and then we see around after adding buffers around 15%. But in reality, we can see the banks are maintaining much higher capital as opposed to that requirement, which gives banks more comfort under any stress scenarios. So this shows us the capital resources at around 20%. This graph here effectively also covers the same concept in a visual way, and you can see we have the CET1 ratio, Tier 1 ratio, and total capital ratio above the standard level of 8%. Okay, so in order to keep this conversation more engaging, I have put some Q&As within this presentation as well. So if you can answer me this question, that would be brilliant. So From which date the Basel 3.1 requirements are effective? You can type your answer in the chat, please. Thank you. Thank you, Mr. Nabil, Syed Farooq, Hafiz, Muhammad, and Zishan. Thank you much for listening attentively. Your answer is correct. It is 1st January 2027. The second question which we have here is, what is the fully phased in output floor percentage that applies to an institution's total risk exposure amount? So if you could tell me what is the fully phased in total risk exposure, total fully phased in output floor value, please. Thank you much, Nadeem, Ayman, Zafar, Rahil. Thank you much for your listening and contribution. Thank you much. Yeah. Now let's move on to the capital requirement side. So effectively, we just wanted to make a link between how the capital resources and capital requirements work together, and the output floor concept which has been introduced as well. Okay. So this slide here explains the key risk which a bank has based on the type of activity which bank undertakes, and different approaches which the bank uses as per the regulations in order to compute the capital requirements for those exposures. So under the standardized approach, uh, we have different. So for credit risk, there are two approaches at a high level. We have the standardized approach and we have the internal rating based approach, which is the model approach. Under the standardized approach, we need to put the exposures into different classifications. For example, we have sovereigns, institutions, corporates, retail, so on. And similarly, for the internal rating based approach, the exposure are split into different categorization as is mentioned below. For the market risk, we have a simplified standardized approach, which based again on the trading activity which the bank takes. If you have equity trading book exposure, you will have to compute the capital requirements, similarly for commodities and so on. And the advanced standardized approach has been introduced under Basel 3.1 only, and this is a lot more risk sensitive. And it uses new type of attributes, including the default risk charge, residual risk add-on, and the delta, vega, and curvature values. And it is a lot more complex than the simplified approach, which is currently in play. And the internal model approach is also available but the new IMA approach under the fundamental review of trading book, that element has been deferred until 1st January 28. So that is not being implemented from 1st January 27. It has been delayed by another 1 year. So CV risk is another type of capital requirement which is attributable to your securitization and your derivatives only. And there are two approaches under that, BACVA and the SACVA requirements. Operational risk, there used to be three approaches and they have been, I think, removed. And there's only one new approach which has been introduced, which is the standardized approach. So there is no modeled approach available anymore to compute the operational risk requirement. There's only one standardized approach which every bank will have to use in order to compute the standardized operational risk requirement. And it depends upon the business indicator, which is based on the revenue of the firm And then the business BI component, which is based on the internal loss multiplier, and it requires more than 10 year of history of the loss values. So this is a new type of requirement, and it is based on actual losses which bank had incurred and the actual revenues the which bank has as well. So it's more sophisticated than the existing basic indicator approach or the standardized approach which the bank is using. And the advanced approach has been removed entirely. So at a high level, we have under the pillar one capital requirements, there are credit risk, market risk, CVA risk, and operational risk based on the activities of the bank. And based on the size of the portfolio, different banks use different approaches. Simpler banks will go for the standardized approach or simplified standardized approach for the market risk. SSCVA, if they have any derivatives or securitization, and obviously standardized approach for operational risk applicable to all the banks. So this is a very high level view of all the approaches under the Basel 3.1. Output floor we have seen earlier as well that the output floor has been introduced under Article 92, which effectively limits the benefit of the models which the banks can use. Okay. Now let's dig deep into the standardized approach on the credit risk. So standardized approach is the default approach which all the banks can use in order to compute the capital requirements for the credit risk which the bank has due to under its operations. It is applicable to the PRA authorized bank building societies, and the risk weight formula is fairly simple. If you have a loan of 100, you need to understand which counterparty it is, and based on the credit rating of the counterparty, you effectively use a CQS based risk weight percentage, and that risk weight percentage is multiplied with that exposure amount in order to provide you the risk weighted asset for that particular exposure. So this approach provides you the standardized risk weights with the as per the rules, and then these can be used based on the credit rating of the counterparties, or if counterparty is not rated, then there are different type of risk weights also prescribed. So the benefit of this one is it provides a more level playing field for all the banks. But the banks, the sophisticated banks would prefer the IRB approach in order to gain the benefit of the regulation in order to uh, use better data in order to come up with a better capital requirement to manage their resources in a better way. Okay, so so in order to apply the standardized approach on the credit risk, firstly you need to identify or allocate your exposures and within your systems in a way that they can be classified correctly. So in order to classify any exposure, you have to split them uh, based on the exposure classification as we saw earlier, like institutions, banks, and retail, and so on. You need to apply the ISIC codes. So ISIC is a standard classification of economic activity based on internationally agreed concept and rules. And IC codes are standard available in the industry. And in order to, at the time of onboarding of a client, an IC code is assigned to the client, which effectively helps in assigning the correct risk classification to that client. So if you assign a banking IC code to a client, then it will be easily mapped into the banking classification for the credit risk reporting. But by mistake, if you assign it a corporate one, then it will flow into the corporate category and it will be allocated the wrong risk weight due to that reason. So correct classification or correct assignment of IC codes is extremely important for correct classification of exposures. Legal entity identifier is another very important attribute because this ensures that counterparty across all the systems is identified and only considered once. So, for example, if you have different exposures to a counterparty, a loan, a derivative, and different systems are used, different source systems are used for those, and the name written in those systems is not consistent, that can lead to mistakes, and one counterparty could be uh, considered as multiple counterparties, and the eventual exposure to that counterparty would be understated due to that reason. So, in order to avoid that, legal entity identifiers are assigned to the counterparties. This is again international. So, these are available publicly. This is publicly available information, and uh, a bank, for example, if a corporate has an exposure to one bank versus another bank, that legal entity identifier will be consistent, and all the different banks will be recognizing that counterparty with the same legal ID, legal entity identifier. Okay. And this makes sure that the exposure is recognized once and consistently across all the systems, and it helps you meet the large exposure requirements, which is a very key requirement as well, along with the credit risk requirements. SME classification. So there are specific benefits or specific regulatory requirements for small and medium enterprises. So identification of a counterparty as an SME at the time of onboarding, and continuous monitoring of that attribute is also very important in order to compute the correct risk weight for that counterparty. As per the regulation, the if the annual turnover for the counterparty is less than GBP 44 million, then it can be classified as an SME. This is an attribute which is used for the classification of the counterparties as a SME. So in order to have the correct classification of exposures, we consider at least these three attributes. There's another one, NACE code as well, but I'll focus on these three at this point. Okay. So we look at the first classification under the uh, standardized approach. So under standardized approach, there's a classification under Article 114 as central government. So if a bank has exposures to central government, they are required to be reported for capital government perspective using the if the counterparty is rated, then we have to consider their external rating. In this case, the table provides rating by different rating agencies, and it is mapped to the credit quality steps. So in this case, I picked up the Fitch rating and then the relevant credit quality step for those as well. So if the central government or central bank has a rating, say, of A, then it will be assigned a credit quality step of 2. And then for risk weighting purpose, it will be the risk weight of 20% will be used for that counterparty. So here we can see there is no model used. It is fully prescribed risk weighting, which has been assigned for this one. So the rule further says that for the UK central government and Bank of England, they receive a risk weight at the 0%, and the European Central Bank also receive a risk weight of 0%. Okay. So a new requirement which has been introduced under the standardized approach for under the Basel 3.1 is a due diligence requirement. Under the existing regulation, which is Basel 3, if you have any exposures, you don't need to use the due diligence. You can simply pick up the external rating and you can apply the external rating based on based on the standard tables available. But going forward, you will have to consider not only just the external rating, but the firms will have to put the due diligence as well. So they need to establish a due diligence framework, put together a proper practice for due diligence, and then based on that due diligence, if they identify that the counterparty external rating does not fully correctly represent the risk to the organization, then they can use a higher notch. For example, rather than reporting it under 2, they can report it under 3 if they think that their due diligence indicates some additional risk factors. So this is a very important requirement which has been introduced, and this obviously introduces additional burden for the banks as well. But this helps, this reduces the reliance on external rating purely, and it helps banks make more informed decision based on their portfolios. I'll leave this slide here for a few seconds and just for your reading, and then we move on to the next one.
Vakar sir, I have a small question.
Go on,
With
please.
respect to this legal entity identifier, right? Is it
Mhm.
same as the BIC code, which is used in the UK banks, BIC bank identification code, which is 7 to 11 characters code?
Now, legal entity identifier is a 20 character code, and if you want to explore it, you can simply search it on a search engine, and you can, if you know any counterparty name, any entity name, you can literally go to a search engine and look for a legal entity identifier for it. It's publicly available information, but it is separate from the PIC code.
Okay, thank you.
Yeah, yeah, yeah. Okay. Thank you for this, Kalim. Um, Moving on to question which I have for the attendees now. Okay, what risk rate applies to the exposure to the UK central government or Bank of England? Very easy question. So we have got few answers. Um, Thank you, Haram. I think the boss has not given the correct answer here. It's not 20%, it's 20%, it's 0%. So yeah. So let's go back to the document again. So for UK Central Government and Bank of England, as well as for the European Central Bank, because these counterparties have are most stable organizations or most reliable sort of organization, they are the regulators effectively. So, and banks are required to maintain certain deposits with these organizations. Yeah. So if you put deposits with them and they ask you to put a risk weight against it as well, it won't be very fair. So in order to facilitate that requirement and to look at the credit rating of those organizations as well, um, uh, there is no effectively risk weight allocated to those. So these organizations are at 0% risk weight institutions. Yeah. Okay. Thank you much for this. Moving on to regional governments and public sector entities. So the concept remains the same. So you have to consider whether the counterparty is rated or unrated. And then based on that, if a counterparty is rated, there is a table based on the rating of that counterparty available under the respective article, which is 115 for the regional governments or local authorities, and 116 for public sector entities. And based on that, if you have a UK regional government, which is these three one, they are specifically assigned a 0% risk weight as well. And if it is other regional government other than these, they will be based on its rating. So if they are rated, then there will be a credit quality step, and against that, there will be a risk weight ranging from 20 to 150%. For unrated regional governments, the rate is 100%. Okay. For the public sector entities without rating, they use the UK central government rating, which and then it is 20 to 150%, and then based on the public sector PSC external rating. So if the PSC is rating, it will be using a 20 to 150% risk weight, and if the PSC is not rating, it will be using the UK central government rating as well. Okay. So the concept is for rated counterparties, you pick up their rating, you multiply it with the credit quality step, you get your risk weights, you multiply it with the exposure, you have your risk weighted asset amount. So standardized is fairly easy to use, prescribed, and I think there are a few data attributes which you need in order to apply these values. There is a concept of short term as well. The public sector entities with an original maturity of 3 months or less, the risk weight is prescribed at 20%. So for the PSCs with a short term maturity, there's a 20% risk weight applicable as well. Okay. The institution exposures, there are quite a few changes in this area as compared to the existing Basel III regulations. The key concept for the rated institutions, that is fairly consistent. We have a risk weight ranging from 20 to 150% based on the credit quality step. Uh, and again, we have a concept of short-term credit assessment as well. So if you have a short-term credit assessment for a counterparty, then you apply different risk weighting based on the credit quality steps available. So long-term credit risk assessment versus the short-term credit assessment. And then again, you will perform the due diligence. And if your due diligence highlights that the risk weight based on the credit quality steps is not appropriate, is not reflecting the correct risk weight for the counterparty, then you will be applying one notch higher uh, exposure for that counterparty. Banks can put in place the internal system under Article 121, and they can assign counterparties, which are institutions, as grade A, grade B, and grade C. And based on those grades, based on their internal assessment, they can apply lower risk weights to those institutions as well. So, but obviously that requires setting up proper controls in place, proper infrastructure in place, and proper authorizations. So if you establish a proper credit risk assessment process, there is some benefit. Rather than applying 100% risk weight to the unrated counterparties, you can classify them under grade A and B, and then you can gain the benefit of lower risk weights. But if they end up with a bad grading, then obviously the risk weight is higher than the unrated. So PR expectation in this regard is that firm must apply consistent grading methodology and maintain adequate documentation for all classifications. It has to be consistent. It should be fully documented, fully audit trail should be available for the approach which has been used. So just to summarize it, we have the long-term rating concept, we have the short-term rating concept, then comes the due diligence. And if the institution's exposures are not rated, then you have to build in the internal grading concept and apply it consistently, by which people can, which by which the bank can use lower risk weights as well. I'll just leave it here for a second and then we move on. So corporate is another classification. For the corporates, it is broken down again under different areas. So we have for the rated corporates, externally rated corporates, the risk weights are fairly consistent, 20 to 150%, similar to the institutions which we have seen. Unrated corporates get a risk weight of 100%, and if the SME, if the corporate is classified as SME, as per the SME definition which we have seen before, less than 44 million revenue, then that corporate gets a beneficial risk weight of 85%. So we have seen the benefit of classification here. So using the correct IC code and the correct classification for SME based on the attribute of revenue, you can assign a counterparty as SME, and as a result, you will be charging lower risk weight for those counterparties. Okay. Similar to the institutions, the concept of short-term credit assessment is also applicable, and which with the four bands with the similar risk weights as well. Here, a similar new concept also exists. So under the Basel 3.1, if apologies, if you you can classify the counterparties as investment grade, you have to get a prior permission from the PRA in order to establish that process. And if the PRA provides you that permission, you can set up that framework and you can assign counterparties as investment grade, which will reduce the risk weights to 65%. And the counterparties which will not be assigned investment grade, they will be charging a higher risk weight of 135%. So PRA is again encouraging banks to establish additional due diligence, do additional work, identify their exposures in a better way. And if they can identify those exposures and sign them as investment grade, the risk weight, there's a benefit of 35% risk weight as opposed to the using unrated corporate 100 risk weight 100%. So from that perspective, this is a step in the right direction. And by adding additional due diligence for institution exposures as well as for corporate exposures, banks will be making some saving on the risk weight assets. For specialized lending exposures, which include object finance, commodity finance, and so on, there is a specific risk weight of 100%. And for project finance exposures, depending on the stage of the project, the risk weight is 130% to 100%. Okay, I'll take a small pause for everyone to read this one a bit more detail, and then we move on to the next one. Okay, another question for you. What is the risk weight for unrated corporates? I'll just wait for a few more seconds in order for more participants to respond. Okay, so so the risk weight for unrated corporates is 100%. But if the bank applies the due diligence and gets permission from the PRA and classifies them as investment grade, only in that case it can be brought down to 65%. Okay, so we'll start with 100% as default. But if the bank has a specific permission from PRA and they can correctly classify it as investment grade, then in that case the rate goes down to 65%. Thank you much for this. All right, so now we look at our worked example. Again, all the values are hypothetical. So here we have bank, ABC Bank, and it has a customer, and then we have a loan issued to that customer. So we have corporate loan by 10 million, which is AAA rated, and another corporate loan which is double B rated, unrated corporate, and the SME loan as well. So in order to apply the risk weights for these based on the credit quality steps, we assign the correct uh, risk weight based on the table to these counterparties. So 20% is assigned to the double A, and then for the double B rated counterparty, the risk weight is 150%. For the unrated corporate, it is 100%. And then for the SMEs, 85% risk weight is used. We simply multiply these exposures with the relevant risk weights in order to get the total risk weight requirement of 19.2 million. And we multiply it with 8% to get the minimum capital requirement against these. So effectively, the standardized is fairly simple. The attributes to look for are the rating of the counterparty and the short-term versus the long-term nature of the rating. If you identify that, and then you can easily apply the risk weight based on that. And if the counterparty is unrated, it's 100%. But if you have done your internal grading, then based on that grading, you can apply the beneficial risk weight as well. But it has to be consistent. It has to be fully trailed. Audit trail should be fully available for that information. Okay, we will look at the retail exposures now. Similar to other exposure classes we have seen, retail exposure has also been enhanced materially. The rules have changed and they have brought further granular percentages of risk weight as opposed to higher risk weight percentage which we used to have, still have actually under Basel 3. So from next year, the exposure will need to be split between the transactor exposure, regulatory retail exposure, or other retail exposures. And based on the nature or the classification, they will be applied the risk weights as applicable. So transactor is an exposure. For example, if you have a credit card that is fully paid every month, That is called a transactor exposure. And then the regulatory retail, there are specific criteria which need to be met to classify a counterparty as a regulatory retail. And then regulatory retail includes both individuals and small and medium enterprises as well. And then if it is not met that criteria, then that counterparty will be classified as other retail and ending up with a higher risk weight of 100%. So there is a benefit available, and the banks can enhance their systems to get all the relevant data attributes available to classify the counterparties correctly between transactor, regulatory, and other. And as a result, they will be able to apply a lower risk weight and gain the benefit of these regulations. For small and medium enterprises, the the total exposure to the counterparty or the group of counterparties has to be less than 880,000 in order for it to be meeting the retail criteria. And the qualifying criteria for regulatory retail is unsecured, revolving, low individual limits, and product homogeneity. So they need to be, yeah, they should homogeneity in the products as well. If we look at this bucket, there is a additional benefit which has been given to specific exposures only. So if some exposure is guaranteed against the salary or pension, the banks can apply a much lower risk weight of 35%. So again, we have uh, additional benefit available for the banks if the data quality is good and the banks have all the systems available to use this benefit. In order to meet all these requirements, appropriate risk management system should be put in place to correctly classify the customers, validate it, and then apply the correct risk weights on it. So we can't stress more on the quality of the data. I'll just leave it for a few seconds and then we move on to the next one. Okay, so risk weight for qualifying regulatory retail. So everyone, if you could kindly let me know uh, what is the risk weight for qualifying regulatory retail exposures? Any more participants, please? We have answer from Nabil, Zafar, Kurutalain, Khurram. Any more thoughts? What about 100% or 75%? Okay, so in this case, the answer is 75%, which is B. So if you have exposures which are regulated retail in nature, the 75% applies. But if those exposures are transactor, only then 45% will apply. And the 35% is limited only to the exposure which are guaranteed in a very specific way. So the answer for regulatory retail is 75%. Thank you much everyone for your response. Okay. Um, we have completed 1 hour into this presentation. Kalim, would that be appropriate if you take a 5 minutes break and then we come back?
Yes, for Garsam, I think that would be fine. It depends upon the participants as well. If they want to build momentum, then we can continue. Otherwise, 5 minutes break would be a fine.
Yeah. Okay.
So,
Perfect.
dear
So
participants, we
guys,
will we will join after 5 minutes. Short break. Okay, for namaz. Yeah, yeah. Thank you so much. Look
thank you very
forward
much.
to your
Thank you.
participation again. Thank you.
Thank you. Hi everyone, Kalim, are you back?
Mm. Yes, yes. Yeah.
Perfect. So thank you much everyone for being with us again. Let's make a start. Bismillahirrahmanirrahim. So now we should look at the exposure class, which is called the real estate. Real estate class has been enhanced materially, and now the banks can make use of benefit of the granular loan to value ratios which are available. So before there was a fixed rate without available under the current regulations uh, for the retail exposures and the commercial real estate exposures, residential versus the commercial real estate exposures. But now we can see it has been granularized further. So let's dig into it. So we have regulatory residential real estate exposure under Article 124F. Uh, and the risk weight up to 55% of the property value is at 20% risk weighted asset only. So this is a huge benefit for the banks. Uh, and anything which exceeds 55% of the property value, the counterparty risk weight rating is considered for that area. There's a attribute to be considered for this one, which is the exposure should not be materially dependent on the cash flow generated by the property. So here we can see the buy to let versus non-buy to let concept. So if it is used for residential own purposes and there is no cash flow generated by the property and the repayment of the mortgage is not dependent upon the cash flow generated by the property, then you can use this concept and you can apply a 20% risk weight for these exposures. Similarly, for the regulatory commercial real estate under Article 124H, uh, for similar LTV, the rate is 60%. And again, the same requirement that not materially dependent upon the cash flow generated by the property. So by adding this additional attribute and considering the LTV percentage, the risk weight has been materially reduced as opposed to the current regulations. And the properties which are materially dependent on the cash flows, there is a separate categorization available for those. For regulatory residential real estate exposures versus the commercial real estate exposures. And that is based on the LTV percentage. So depending upon different LTV percentages, different rates of risk-weighted assets are applied. And for commercial, we have 100% RWA if it is less than 80%, and if it is more than 80%, 110% is applied for those ones. So this is a change which is welcomed by the banks, and this effectively encourages them to offer customers better rates, possibly for uh, if they can offer a lower loan to value. And I think it brings benefit to the banks on the risk-weighted asset perspective. And LTV is based on the current market value or recent professional valuation. So the LTV values need to be considered and obviously updated within the bank system as well in order to take the benefit of the lower loan to value ratios as well. So this is a material change in Basel 3.1 regulations as opposed to Basel 3. So continuing with our questions, risk weight for regulatory residential real estate exposures, not materially dependent on cash flow generated by a property. So this is not materially dependent. So it must be on those top buckets which we saw. So if you could kindly respond, that would be brilliant. Any more thoughts? And I can say that Nabil and Zafar have been consistently answering the correct question, and Mr. Zuberi has also answered Zuberi has also answered the correct question now as well. Um, okay, so yeah, the correct answer is 20% in this case. Thank you. All right. So we looked at governments, we looked at regional governments, we looked at institutions, corporates, uh, retail, and then the residential and commercial real estate as well. However, there are some additional categories as well on which specific risk weights are available. Uh, one of the one of them is the past due exposures. Any exposure, any type of exposure, if it is past due, which means the exposure is more than 90 days overdue, then we have to put 150% risk weight on it, and that is on the net of the net of the provision amount. There is some relaxation available. So if you have when specific provision against that exposure is less than 20%, the risk weight is 100%. Oh, sorry, 150%. But if the specific provision is more than 20%, then you are allowed to use a lesser risk weight of 100% for those. So again, it comes down to having the correct data available and the correct provision available against that customer. So if you can link the two together, you can gain benefit of 100% risk weight rather than applying a higher risk weight of 150%. The exposures in the high risk categories, so venture capital, private equity, or speculative real estate, uh, depending upon their nature, very prudently a higher risk weight has been prescribed at 150%. And equity exposures are allowed to take a risk weight at 250%. But if they are higher risk equity exposures, there is a much higher risk weight charge of 400%. So we can see for past due 150%, depending upon provision, high risk category is 150%, and equity is a much higher risk weight of 250% under the standardized. Another thing I want to highlight here is that equities are no longer allowed under the advanced approach. So you are stuck with the standardized and you're stuck with a very, very high risk weight as well. So that is a key change from the risk weight perspective. So cash in hand, gold bullion, very favorable. Obviously, cash is cash, so there is 0% risk weight. But if the cash is in the process of collection, there's a 20% risk weight on that. And then we have the gold bullion at 0% risk weight. And then we have the covered bonds, which is a variable risk weight between 10 to 100% based on the rating as per the Article 129. Again, if we dig deep into Article 134, for tangible assets, prepayments, and accrued income, the 100% risk weight is also applicable. Here, I would like to mention some very important concept, which is called the off-balance sheet. So, if a customer takes a loan from a bank, say of 100,000, and against that withdraws only 70,000, that 70,000 sits as the on-balance sheet exposure for the bank, and the remaining 30,000 sits as the off-balance sheet exposure for the bank. And there is a specific conversion factors available depending upon the nature of the exposure, which need to be applied to that exposure, consider the appropriate value which should be considered for the risk weight. And based on that, so direct credit substitutes are applied 100% credit conversion factor. Performance guarantee is 50% and trade finance at 20%. So there's a detailed table available with a lot more detail. I've just highlighted a few examples here. So rather than applying 100% charge to the off-balance sheet exposures, they are broken down. They are uh, analyzed based on their, I think, stickiness, I would say, or their nature, to compute the credit conversion factor and get the value after that, and then apply the risk weight. So a person, the exposure might end up at 90,000 rather than 100,000, depending upon the nature of the exposure which we have. So there would be a benefit. The 100,000 rather than 100,000, you will be considering 90,000 for your risk weight exposure purposes for that one. So off balance sheet is a key factor which is applied during the risk weight calculation. Okay, so here we see what could go wrong in the standardized approach. A bank needs to have exposures application under the standardized based on the nature of business it has. The way it starts is onboarding. At the time of onboarding, you might not identify the customer correctly. It goes into wrong classification, wrong risk weightage charge. The external rating which are applied are not correct. You applied short term incorrectly to a long term one. You end up with a wrong risk charge against on that one. Incorrect EAD or CCF might not be, CCF is the credit conversion factor, which we just looked at, or the netting might not be correct as well. Uh, you are applying the collaterals without considering their eligibility criteria correctly. Uh, Again, it could lead to the wrong risk weight assets. The substitution based on the guarantees is not correct, or the collateral haircuts are not applied correctly. Um, Similarly, you're not, say for example in this case, you might not be applying the correct buckets, like the transactor 45% might not be applied correctly. If some loan is not fully repaid every month and you apply transactor on it will be non-compliance with the Basel 3.1 regulations. Incorrect use of national discretions. For example, PRA has some discretion which has taken as opposed to the EBA regulations. So if someone is applying the regulation inconsistently to the PRA regulations, they are using the EBA discretions or they're not applying the PRA discretions correctly, then that will lead to the incorrect reporting eventually. And systems, manual overrides in the system, so that can cause a problem. So all of these data input issues, calculation and methodology issues, rules interpretation, and system and control issues are something which will impact your classification of the exposure, your computation of the risk weights, and your eventual reporting of the exposure as well, and impacts how you manage your business and how you maintain the capital as required in line with the regulations. So these are the common type of issues which can take place in the standardized approach. On my screen here now is a report, which is the C7 credit risk report for under the standardized exposure. And it's a very complex report, and I've just taken a few columns out of that report in order to show you how the way we have studied this one. So here we can see the original exposure. This is effectively the exposure without application of the off-balance sheet credit conversion factors. And after that, we have the provision amount, and then we take the exposure net of provision. And that is after that, we apply any guarantees, which is the unfunded credit protection, and then we apply any funded credit protection as well. And after that, we get the net amount of the exposure. Here we are applying the credit conversion factor, which is the off-balance sheet impact to reduce the exposure accordingly based on the nature of the exposure. And based on that, we get our final exposure value. And on final exposure value, based on the external rating of the counterparty, or considering the unrated, or considering the grade A or B or so for institutions, or the investment grading for the corporate, we will apply the relevant risk weights to it to get our risk weighted exposure amount. So you can see the flow, it works very nicely. And then we have total exposure, defaulted exposure, SMEs, and then exposure to specialized lending on separate lines as well. So this is the quarterly report which is required under Basel 3.1 from 1st of January 2027. So the first instance for this one will be for March 31st March 2027. These reports are submitted after 40 days of the due reference date. So yeah, so I think that report goes out of the door around 11th or 12th of May. Yeah, as standard. So these dates are prescribed by PRA. They are available on the website. Yeah. So this is how the C7 credit risk report flows. Okay. We looked at the standardized approach in fairly good detail. Now we'll move on to the internal rating based approach. Internal rating based approach is where we apply the internal models in order to compute the risk weights for different counterparties. Uh, IRB provides more risk sensitive capital requirements compared to the standardized. Obviously, in the standardized, you're taking the external rating of the counterparty, although you are doing some due diligence, but again, you're still based on external counterparty plus due diligence rather than applying all the indicators based on the sensitivities which you have determined based on the data. Uh, so IRB is more risk sensitive. It would result into lower capital requirements, but again, there's a catch now in the form of that output flow. Under the IRB, there are three type of approaches used. One is the foundation IRB approach, second is the advanced IRB approach, and third is the slotting approach, which is used for very specific exposures only. Foundation IRB approach, there are a number of different attributes which are used for computing the RWAs, risk-weighted assets, under the model approaches, and they are called PD, the counterparty, probability of default, loss given default, exposure at default, and maturity. Under the foundation IRB approach, bank can use their models to compute PDs only, and for everything else, they will have to use the supervisory values as per the tables provided by the regulations. So this is less risk sensitive, but obviously you're computing only one attribute, so the model will be relatively simple. And this is useful for the banks which are relatively simple banks as well. Or where the IRB is not available, in that case, you will have to use the foundation IRB approach anyway. Advanced IRB, on the other hand, is used by the big banks and where it is allowed by the regulation. And in that approach, you can compute all the attributes using your models, which includes your PD, LGD, EAD, and maturity. It's highly risk sensitive. Uh, in order to have the models applied on your exposures, you need to have a PRA permission for every exposure type you want to apply IRB. So you need to develop a model. That model will be validated internally, approved internally, and then it will be submitted to the PRA, and PRA will review the model and they will approve the model for specific exposures only. So they may say that you can use it for the corporates, but you cannot use it for your specific type of corporates or specific exposures in a specific country. Yeah. So they can change, they can limit the use of the model uh, based on the risk which they consider. So again, it has to be based on the PRA approval. You have to put very strong internal processes in place. There has to be a model development process, model validation process, and model monitoring process. On top of that, when the model output is computed, PRA may think that the model is not conservative enough, and they may ask you to use some post-model adjustment as well. So they might introduce some additional, say, 5% or 10% charge on top of your model output. So there's a requirement for model backtesting, benchmarking, and so on as well. So, and the IRB estimates, they're not just used for your reporting purpose, they has to be integrated into your risk management and decision making as well. So uh, you need to meet all these regulatory requirements in order to use those model on a going concern basis. Yeah. So it is very complex. It is very, very costly. And but obviously it has some benefits, but those benefits are limited by the output flow now. So standardize a lot more easier, very few data attributes needed in order to do the computation, and uh, universal. Different banks using the same credit rating will result with the same RWA. But under the foundation IRB approach, different banks, similar exposure to the counterparties, may end up with a very different risk weight depending upon the model which they are using. All right. So we move on to the next one. Here I have explained the types and the classification and the model permissions in a bit more detail. So as we mentioned, there are three approaches: slotting, foundation, and advanced IRB. PRA permission is required for each exposure class. Under Basel 3.1, this change is very, very material. So PRA has limited the use of the foundation and advanced IRB by exposure class now. So under the current world, IRB can be used across any of these exposure classes depending upon the permission you have based on your models. From 1st January, for corporates, you can use foundation IRB or AIRB, but there are conditions attached to it, which we'll see in a moment. Institutional exposures can only use the foundation IRB. Retail exposures can use the advanced IRB only, and equities are no longer allowed to use the IRB, and sovereigns are also not allowed to use the IRB. So this is a major change. So it increases the RWA straight away. And as we've seen for equities, the risk weight was 250% and 400%, which is very, very high. So from that perspective, this is a big change. Uh, there's a new input floor concept as well. So the rules have sorry the new regulation have introduced the floors as well. So if your internal model says that the PD probability of default is 1%, but you will still have to apply 0.01%, but in that still you will have to apply 0.05%, a minimum as a PD floor. And for corporate and for retail exposure, it is ranging from 0.05 to 0.1%. So by introduction of these floors, PRA is again making sure that the models are using the at least a minimum criteria and they're not going below that minimum criteria. And it brings fairly standard some sort of standardization across the industry. Similarly, we have the LGD floors applicable for as well by exposure class for unsecured, for residential, and for qualifying regulatory retail and other categories as well. So by breaking down, by limiting the use of approaches for different exposure classes, and by introducing these floors for PDs as well as LGDs, PRA is reducing the uh, bringing the rules, making rules a little bit more conservative and reducing the additional benefit which different bank can take. Okay, this slide here shows us in a lot more detail how different exposure classes can use different approaches. As I summarized previously, central banks only standardize, institutions only foundation, or IRB or sorry, standardized approach with permission. Corporates, depending upon their nature, can use either slotting or foundation IRB approach, or in some cases they can use advanced IRB approach as well, but it has to be with permission as well. For retail, we can see it is under the advanced IRB approach, and for equity exposures and for CIUs and securitization, it is standardized only. So the rules are very, very prescriptive now on different approaches which a bank can use. Here we are looking at the PD and input floor, PD input floors and LGD input floors in a little bit more detail. We can see the floors are provided by exposure class, and yeah, so they will limit the models, and they will make sure the models are conservative enough to compute at least these minimum floors, and it provides some sort of a uniformity across the industry. All right, we have been talking about PD, LGD, and EAD. Let's define them as well. So here I've added the definitions of these terms in line with the regulations. PDs, LGDs, and EADs, they are computed by the IRB model itself, and then obviously after that these models flow into your regulatory reporting engines, and those regulatory engines, those calculation engines produce the risk-weighted assets by considering these attributes. So PD is the probability of default of a counterparty. It is given in the form of a percentage. LGD is the loss given default. Again, it is computed in the form of a percentage as well. For foundation IRB, it is a prescribed value, and for advanced IRB, it is computed by the model, but there's a floor now. And for exposure at default, again, this is the exposure which will be there at the time of the default of a counterparty if it happens. Uh, it includes the undrawn portion as well after the CCF application. And for foundation IRB, it uses the CCFs, and for advanced IRB, use own EADs or CCF subject to the floors. So, and then we have the relevant floors mentioned again here. So these are the key attributes which either the model computes under the advanced IRB, or they are prescribed by the uh, rules for the foundation IRB, and then you compute your PD only under the foundation IRB. So these are the key attributes in order to compute the risk-weighted assets under the advanced IRB approach. Okay, so we shall move on to the next slide. Okay, the formula for computation of the risk weight under the modeled approach is very, very complex as opposed to the standardized. In the standardized, we saw we only needed the rating and we needed to identify the correct credit quality step based on that rating, and we already had the number of risk weight given to us, and we were happy after that. But in this one, it is a lot more complex. So we have the risk weight percentage, which we need to compute by using these two formulas, and we multiply it with the exposure value in order to get the risk weighted exposure amount. Okay, so there are two type of different formulas or two type of concepts we need to consider here. The exposures which are already in default. For those exposures, the PD is at 1. And the exposures which are not in default, for them the PD, the probability of default is less than 1. Yeah. And based on that, there are two different formulas which are used to compute this risk weight percentage. Under the foundation IRB approach, RW shall be 0. And under the advanced IRB approach, the RW will be computed by a maximum of 0 or 12.5%. And we take LGD minus the B, which is the best estimate of expected loss. So again, BEAL is computed in the model itself. You have the model parameters available, and based on that, your regulatory RW calculator will compute the risk-weighted asset amount. Uh, if the exposure is not in default, again you will have your LGDs, you will have your PD, and you have to compute some additional attributes as well, which is a coefficient, which is provided here. So you have to compute a coefficient by using all those fun formulas. You also have to compute maturity of the exposures by using all these different attributes. All of these things happens in the models. They uh, that's why the model are complex. They need approval for their accuracy, and then their dependency, and then the back testing of the models and the stress testing as well is required in order to make sure that the model are actually able to deliver these complex calculations, and the regulatory calculator engine can also deliver these RW values. So you can see for corporates, you can apply the foundation or advanced IRB approach based on the table which we saw. And for the institution, it is only foundation IRB which is applicable. And then you have to compute your LGDs, your coefficient, your PD, and then you apply this fund formula in order to get your RW values. All right. For specialized lending, we use the slotting approach, and then we compute the RWAs based on a specific table, which ranges from 50 to 250%. Yep. And that's for Article 153. And then maturity is capped at 5 years, but for repo type transaction, it could be a day as well. So for the corporate and for the institutions, this is how the risk weights are computed under the advanced IRB approach. We move on to the second category, which is the retail exposures. So for the retail exposures, we have uh, again the same concept, which is the exposures in default and exposures not in default. If the exposure is in default, the formula is fairly simple based on the loss given default and the best estimate of expected loss. And then if the exposure is not in default, we have to come up with the inverse normal distribution. We have to come up with the correlation coefficient as well. And obviously we have the PDs and LGDs available as well. And then the R is defined as well based on the nature of the exposure. So mortgage exposures, unsecured revolving credit, retail exposures, there are different values of R which have been provided. So your model as well as your calculation engine will have to work together in order to compute the RWAs. So the chances of making mistake is a lot more higher in the advanced IRB. And but the benefit is there as well. Obviously, as compared to the standardized, you will still have some benefit, but that is capped due to the floor which has been introduced. There are specific requirements for exposure to be classified as retail. Granularity requirement, homogeneity requirement, their testing requirements as well. So under the Article 154, under Article 181, there are very specific requirements which need to be met in order to classify those exposures as retail, and then using the retail model in order to compute the RWA for those exposures. Okay, going on to what could go wrong in this one. So I think what could go wrong is that forgot to change the heading on this one. So it should say that what could go wrong in the IRB approach rather than the standardized. So in this one, we see again the concerns are very similar, but there are more. They change based on the data which we have. So effectively, your model could cause problem. Your data lineage could be wrong. You have missing fields. For example, your model has thrown a data which does not have the LGD for a counterparty, or the PD is incorrect, or the BEAL value is incorrect. So these are the type of problem can happen into the model output, and if those are missing, then it will lead to incorrect calculation as well. So we have the data quality issues, we have the model parameter issues as well, and then the formula, if these values are missing or incorrect, then the calculation engine obviously is going to make errors as a result, or there will be some default calculations built in which will come up with a value which might not be fully in line with the regulatory requirements. You might end up applying the risk mitigation incorrectly, and then the model changes not properly approved, weak reconciliation between the model output and capital reporting, over reliance on manual adjustments by end user, and insufficient evidence of ongoing monitoring and test of compliance of models. So models make things more complex. There could be error in the model output. There could be error in the model input, which could impact the model output. And again, the regulatory calculation engine can make errors if it does not get a good data. And there could be post-model adjustment issues as well. And then model validation, model monitoring, model approval. Any lack of governance on these spaces effectively can impact the end result, which is your RWAs and the capital requirements. And yeah, so these are the type of issues which can happen if you use the IRB approach. All right, so here we have provided an example of the IRB RWA calculation. In this case, we picked up a corporate exposure. We think the model, obviously, the model will provide you these attributes. So we run a model, and that model has given me an EAD of 15 million with a PD of 0.7% and the LGD of 35%, and the 3 year is the M value. Based on that, if we put it through the formula, we compute the correlation of 20.46%, maturity adjustment factor, maturity adjustment value, and then the capital requirement of 5.39, and the ending risk weight of 7.150%. 7.42%. So 7.142 would translate into 10 million of risk-weighted asset against the 15 million exposure. A capital requirement multiplied by with this one will come down to 857,000. And the loss given default is a multiplier of PD, LGD, and EAD, and that would be 36,000. So effectively, your IRB model will compute these attributes, and then your calculation engine will compute these attributes. Based on that, the final risk-weighted assets and the capital requirement will be computed, and the risk-weighted assets and the EL will flow into your regulatory report. I'll just leave it on screen for a moment. All right. So this was an example for the IRB RW calculation. The IRB return. So IRB return obviously will have the attributes which are used in computing the IRB RWA. This return is called C8.01, done by exposure class. We start with the total exposure, then broken down by different subclassifications: on balance sheet, off balance sheet, and revolving, and so on. We assign the PD. We we have to put the PD value, and then we report the origin exposure pre-conversion factor, uh, adjustment to exposure value as well, and then we come up with our credit risk mitigation, very similar to what we have seen before. But obviously, all of this has happens as part of the models. Then we have the exposure weighted average LGD value, and then we have the maturity days. LGD, PD, maturity, these are all the attributes which are used in computing the RWA. So effectively, the return itself is asking you to report everything which you have used in order to compute those RWAs. Then you come up with the risk weighted exposure amount after adjustments. So effectively, we considered your EAD pre-CCF. There's another column for EAD as well, which is after CCF. And then you have your PD, LGD, and maturity values. And then you report your risk-weighted asset here. Here comes the uh, absolutely brand new item, which is the output floor. The output floor, which we spoke about before. So here, up to here, you have the IRB RWS. Against that, you have to show non-model approach exposure value and the non-model approach RWA. So in this return, you are already comparing what is computed by the model versus what is computed by the standardized approach. Okay, so the control which we're talking about is reflected in this return. I'll leave it here for a second and then we move on. Credit risk mitigation. So credit risk mitigation is very important in order to, number one, as part of the terms of the contract. For example, mortgage, you considering your loan to value, you have a property against the mortgage. If you have secured lending, obviously you take some funded or unfunded credit protection in those cases as well. And for the balance sheet, for the derivatives, you have on balance sheet netting and as well. So there are different type of credit risk mitigations. Now there are very strict criterias which are required to be met for that item to be eligible for credit protection. So if those credit protections which you have taken, they need to meet all those requirements in order to be eligible for either your funded credit protection or your unfunded credit protection, which is guarantees, or for the on balance sheet netting. So here I just wanted to highlight at a high level that within your reports, you have to show what type of a guarantees, credit derivatives, or your other funded credit protection which you have used. And then based on that, you will be able to gain the benefit of these credit protections on your risk-weighted assets. But if your systems and controls are not strong enough, and you have not ensured that you meet all the requirements of the rules for this credit protection, then you will not be able to gain the benefit of the credit risk mitigation, and you will end up with a higher risk-weighted assets. So from that perspective, credit risk mitigation is fairly important, but it is complex, and having appropriate systems in place and having appropriate frameworks in place will make sure that you are taking the benefit of it as you should. Okay. I'll just leave it here for a second for everyone to read and then we move on. Okay. So as part of the PS format 26, there are tons of appendixes with it, and appendix number 17 provides the new reports or the changed reports which have been provided. So there are a number of reports which have some changes into it, and there are some brand new reports as a result of the implementation of the Basel regulations. So the reports like C7 and C8, there are some changes within these reports, but overall these reports remain same. For example, in 8.01, we have seen the output floor. This is a brand new requirement within this one. Uh, so there are some changes obviously made in these reports in order to reflect the that they are updated in line with the regulation changes. The other reports like uh, market risk advanced standardized approach, these are entirely new templates. So here up to here, these are the standard simplified standardized approach for market risk. And this is the IMA, which currently remains changed for 28. There will be new, I think, requirements for IMA. For market risk, for 90 onwards, these are the new templates under the advanced standardized approach. So they are templates under the revised risk sensitive approach templates. And then we have two new templates for the output flow. And the template for operation risk has changed obviously as well, because now there is only one standardized approach available as opposed to basic indicator standardized and the advanced approach previously. So the reporting templates have also changed. You can search it online and you can look at that appendix. And within the appendix, these are the links. You click on the link and you go to the template and you can have a look at the template as well. All right. Okay, so I will conclude here. And I think in this session, we have spoken about own funds. We've spoken about the tier one, tier two capital, and we looked at the output flow. We looked at the standardized approach, which is a prescribed approach as a standard, which is applicable for the credit risk exposures. It is based on the attributes like external rating of the counterparty, and then based on that, you consider the relevant credit quality step to compute the risk-weighted assets. For SMEs, there is a 85% risk weight available still. So the classification of counterparties within SME criteria, looking at the correct attributes is really important. Uh, it is simpler, less complex. You don't have a model. Don't need to do model validation, model governance, and so on. But you will end up with a slightly higher risk weight. For the IRB, three approaches: foundation IRB, advanced IRB, and the slotting as well, which is for specific exposures only. And foundation IRB, you can compute your PD using your models. Under advanced IRB, you compute your PD, LGD, EAD, and maturity using the models. It is for complex banks. It can bring you benefit under the risk weight assets. You have better control on the based on the data which you have and the type of counterparties you take exposure with to come up with a better risk weights. But again, that will be capped by the output flow requirements. And credit risk mitigation, tougher rules on it. You have to meet the eligibility criteria in order to gain the benefit of the credit risk mitigation. So key compliance requirements include the model validation, annual validation, back testing, independence review. Data quality is key in order to ensure the correct reporting and correct compliance with the regulatory requirements. And the comprehensive policies, procedures, and audit trail of all the information is key in order to have these functions working properly. So yeah, so I think in Basel 3.1 is bringing quite a lot of changes. It is making more risk sensitive, making a lot more granular. It has introduced the due diligence requirement as well. People can take the benefit of due diligence for under institutions as well as under corporates. Uh, they can apply lower LTV based on the LTV, lower risk weights as well. Retail has changed under the IRB. The classification to which IRB is available has been changed materially. So sovereigns, for example, will end up under standardized only. Same with equity. A lot has changed, but it has changed for good to make it a better, even playing field for all the banks. And then come up with the risk weight which is conservative enough using the output flow. Yeah, so the banks don't get into trouble at the end of the day. So a positive one is step in the right direction, and UK is implementing it from 1st January 27. And I think yeah. So thank you very much everyone for listening to me and replying with your Q&A answers. We got few minutes left only, so I'll leave the floor to you for any questions which you have. If we can't answer those here, we can reply to you on email as well. So Yeah, if you have any questions, please ask now. Thank you very much. Mm.
Thank you very much, Mr. Vakar, for that highly insightful and comprehensive presentation. I'm sure all participants would agree that the session was extremely informative and provided valuable clarity on a complex and evolving area. I would encourage all participants to share their questions in the chat box. Please feel free to raise any queries or seek clarification on the topics discussed. Mr. Vakar will be happy to address them. With that, I invite your questions. While participants are starting their questions in the chat, I would like to take this opportunity to ask few questions I have during the session. Vakar bhai, what is the main purpose of PRA PS1/26 in the UK's implementation of Basel 3.1?
So the main purpose is to bring in Basel 3.1 regulations inconsistent to the European area. So Europe is the first one to apply the Basel 3.1 regulations. PRA was slightly lagged, and PRA was considering to be more consistent across other jurisdictions. So hence PRA is implementing the regulations from 1st January 27, and PRA is bringing in more risk-sensitive regulations to have better risk-weight assets across the market. And the idea is to stabilize the market more and encourage people to use better data models and bring in more better policies and framework, so they can use the benefit of due diligence and investment grade rating and so on, at the same time applying the output floor as well to have a better level playing field for the market.
Thank you, Vakar Sab. We have a question from Zafar Iqbal. Mr. Zafar Iqbal, how Basel 3.1 will impact companies in Pakistan approaching UK financial institutions for financing?
Okay, so they will need to be considered based on the counterparty rating. So the counterparty rating will be considered for those one. For example, if it's a corporate, it will be considered whether it is rated or not under the standardized approach, and then based on that, the relevant rating will be applied. So a UK bank, wherever it has exposure to, it will be following these regulations, and it will be applying the relevant risk weights or other. If it is using the IRB approach, then it will be applying the IRB approach to compute the risk weight. So wherever the world, the counterparty might be based, but the regulations are consistent across.
Thank you. There's another question. Which areas of the prudential framework are most significantly changed under PS1/26? Thank you.
We have seen changes in the IRB materially. Like in the IRB, we've seen number of exposure classes no longer eligible for the classification, like standardized, sorry, sovereigns and equities. And then for institutions, it's only foundation IRB available now. So this is a big change for the banks. Banks have spent millions over the years developing the models to apply the RWAs under these classifications, and moving from IRB to standardized is a big shift. So that is one key change. And then the other side, the benefit is available on the standardized approach by bringing better LTVs and gaining the benefit of lower risk weights. Output floor is the biggest change, I would say, in the credit risk space. But for the market risk, the advanced standardized approach is a lot more risk sensitive and a lot more complex. It is almost as good as a model. So I think that is also quite a big change. And operational risk is changing to only one approach, which is the standardized approach. So changes are across the board, and they are working together to, I think, make it better for everyone. More conservative risk weights.
Thank you, Vakar Sab, for such a great explanation. There's another question from one of the participants. Why is PS1/26 important for UK firms from a risk management and audit perspective?
Yeah, so from a risk management audit perspective, as the rules have changed, we have to make sure that the internal frameworks have been updated in order to comply with those new regulations. And then the systems have also been modified to implement those regulations. So from system and framework perspective, all the changes are required and they need to be implemented ahead of the timeline and need to be approved as well. And from audit perspective, obviously the requirement will be to ensure that those changes have been implemented in line with the regulations. And then audit will need to update their approach and need to do a specific due diligence within this space as well.
Thank you, Vakar Sab. I think we have covered all the questions. Uh, any participant who wants to send a query related to this, you can send an email to ukchapter@icap.org.pk. I will repeat
Okay.
UK chapter at icap.org.pk. If there are no more questions, then I think we should proceed for closing off the session.
Just just before we close, I really appreciate and thank you all the participants for your participation within this one and providing your time to attend this training. We have another training coming up. After this one, we'll continue with another 2 hour presentation in the coming months. Before we conclude, I just want to say one thing that let's do a good deed after this training session. If you can feed somebody, if you can give food to somebody, any needy person, that will be a very good deed, and I really appreciate it. So thank you very much for your time to attend this meeting, this training session here. And I look forward for your participation in the future as well. And thank you very much, Kaleem and the UK ICAP chapter for organizing this one. Thank you very much for your support. Very helpful.
Thank you, Waqar Sab, for potentially addressing the questions and for your kind suggestion as well. Your expertise and practical perspectives have truly enriched this session. As we conclude today's webinar, I hope you found the discussion on credit risk capital requirements and reporting rules both insightful and relevant to your professional roles. This session is part of our continued commitment to bringing you specialized and high quality learning opportunities, and we look forward to your participation in the upcoming sessions of this series. On behalf of the UK Ireland chapter of ICAP members, I sincerely appreciate your time and presence today. Please stay connected with us for future events and initiatives. With that, we bring today's session to a close. Thank you once again. Assalamu alaikum, and I have a wonderful evening. Thank you.
Thank you very much. Bye.